Joining in. By the way, the pre-opening rates are settling mildly lower. The Nifty is down about 40 odd points. The Sensex is down 240 points. It would be interesting to see a couple of reactions. Macro tech developers numbers are slightly on the weaker side. The Cholamandalam numbers have been good. Nykaa has spoken about weakness in its fashion business. So these are all the stocks that will be in focus. But yesterday and in the last few days, a slew of banks and NBFCs came out with their numbers. Nitin Aggarwal of Motilal Oswal Financial Services joins us now to talk about that and how he's seeing the entire sector. Nitin, I want to talk to you about Bajaj Finance. It was clearly the stock of the day yesterday in the NBFC space. After a good set of numbers. But the stock is still down about 15% in this calendar year. Do you see the risk reward be favorable for long-term investors now?
So, we are not exactly like, it's not on the top of the ideas that we have in the NBFC space. And though the performance continues to remain pretty strong, and in terms of customer additions and growth, the company is delivering. But at the same time, the entire sector is going through a phase of derating, and which has affected the growth of most high valuation stocks in the sector. So therefore we continue to prefer other ideas in the space, wherein we like MMFS, Chola, Shriram amongst the top ideas.
This changes in taxation, Nitin, which happened, which takes away, sort of debt mutual funds, insurance as a source of funding. Is that likely to have any impact, according to you, for the entire NBFC space, or not really?
There will likely be some increase in funding costs. That's quite possible, and because with the incidence of tax now on the debt mutual funds, the investors may demand slightly higher returns, and to that extent, while banks will likely benefit at the margin, though the number is quite small to really move the needle for the banking deposits, but for NBFCs wherein mutual funds play a significant role in terms of their funding, there could be some marginal uptick in funding costs. But I think the bigger driver will still be as to how they manage their own asset mix and yields, and that will move the margin much more than this alone.
So by and large, isn't it better to stick with banks in an environment like this?
Definitely, we continue to like banks, and wherein we see that the earnings momentum is going very strong. If you look at like 23, we are looking at a 46% sort of earnings, and incrementally, also we expect the sector to deliver 20% earning growth over FY24 and 25. Okay. There could be year-to-year variations because of the margins and the credit cost normalization, but I think the sector is still well placed to deliver amongst the best of the earnings in the entire markets.
All right. Hi, Nitin. Good morning. Thanks so much for joining in. Nitin, since you like banks, what's the toss-up between HDFC Bank and ICICI Bank? Over the last 5 years, the big re-rating took place in ICICI Bank. But in the last 6 months, it seems HDFC Bank is pulling back quite a bit, and it's outperformed ICICI Bank. How do you view these two?
So actually, we like both these stocks. While ICICI Bank from the lows has re-rated consistently, especially after the management change, and we still see it delivering very steady earnings over the coming years. It's like becoming more of like coming on an autopilot mode, wherein things across multiple fronts, be it assets, liabilities, asset quality, margins, is now like reaching the industry best levels. But HDFC Bank, after announcing the merger, there was some sort of an overhang as to how the growth can pan out. But I think the recent quarter performance, especially on the deposit front, quashes all the concerns that have been there on the around as to how the merged entity can generate enough liabilities to fund the growth. And we believe that the entity is well poised to deliver 17-18% growth on a merged basis, and which therefore leaves a good scope for re-rating in the stock.
Re-rating of HDFC Bank, you said?
Yes.
Okay, got that. The other stock which has delivered a very good set of numbers this time is IndusInd Bank. There's been a loan growth of, it's been the best in 15-16 quarters. Deposit growth is almost about 15% this time around. Is that a stock you like as well, and do you see a re-rating there?
Yes. So IndusInd Bank has been delivering pretty healthy performance. If you look at over the last more than 2 years, every quarter there is an uptick in the reported earnings. And now the loan growth is also gaining momentum. And incrementally, we expect the stock to deliver 20% plus loan growth over FY24 and 25 because some of the key segments like MFI, CV are going pretty strong, and it will be well supported by the growth in the other verticals like SME and affordable housing with corporates. And therefore, ROA overall, which is right now talking around 1.8 to 1.9, it has a good scope to expand above 2 over the coming years. And that should drive a re-rating in the stock in our view.
Do you track any of the housing finance companies, Nitin?
Yeah, so we look at the affordable housing companies. Of course, we track HDFC, Canson, PNB, and many other affordable housing names.
And there, what is your top? Anything you like, given where prices are?
So there has been some I think it needs to be looked at still on a case-to-case basis, because in some places the managements have changed, in some places there have been concerns on margins. So we like relatively home first with our affordable housing names and PNB housing.
All right, we leave it at that. Thanks a lot for joining in and speaking to CNBC TV 18. So that's on the the updates, business updates that came in from the banking and financial space. By the way, a couple of stocks